Hello dear friends, today we are going to discuss in the present module 2.6 relating to the security markets. The present module covering the main aspects of meaning of security markets, primary and secondary markets, primary market terminologies, role of secondary market and the secondary market structure and its participants. Then the security market products and related things. So first of all, we need to understand what is security market. It is a market in which securities are issued, purchased by investors and subsequently transferred among investors is called the security market. The security market has two interdependent and inseparable segments. The first segment is primary market. The primary market, also called the new issue market, is where issuers raise capital by issuing securities to investors. Fresh securities are issued in this market. The another segment, that is secondary market. The secondary market facilitates trades in already issued securities, thereby enabling investors to exit from an investment or new investors to buy the already existing securities. The primary market facilitates creation of financial assets and the secondary market facilitates their marketability or tradability, which makes these two segments of financial markets interdependent and inseparable. We shall look at each of the markets in detail in the next section. The first, that is a primary market. As stated above, the primary market is used by companies or issuers for raising fresh capital from the investors. Primary market offerings may be public offering or an offer to a select group of investors in a private placement program. The shares offered may be new shares issued by the company, or it may be an offer for sale where an existing large investor or investors or promoters offer a portion of their holding to the public. Let us understand various terms used in the primary market. The first term, that is public issue. The securities are issued to the members of the public and anyone eligible to invest can participate in the issue. This is primarily a retail issue of securities. Then another term is initial public offer or IPO. An IPO is the first sale of a corporate's common shares to investors at large. The main purpose of an IPO is to raise equity capital for further growth of the business. Eligibility criteria for raising capital from the public investors is defined by SEBI in its regulations and include minimum requirements for net tangible assets, profitability and net worth. SEBI's regulations also impose timeliness within which the securities must be issued and other requirements such as mandatory listing of the shares on a nationwide stock exchange and offering the shares in dematerialized form, etc. Another term is FPO or follow-on public offer. When an already listed company makes either a fresh issue of securities to the public or an offer for sale to the public is called FPO. When a company wants additional capital for growth or desires to redo its capital structure by retiring debt, it raises equity capital through a fresh issue of capital in a follow-on public offer. A follow-on public offer may also be through an offer for sale, which usually happens when it is necessary to increase the public shareholding in the company to meet the regulatory requirements. Another term is private placement. When an issuer makes an issue of securities to a select group of persons and which is neither a rights issue nor a public issue, it is called private placement. This is primarily a wholesale issue of securities to institutional investors. The next term is QIP or qualified institutional placements. QIP is a private placement of shares made by a listed company to a certain identified categories of investors known as qualified institutional buyers or QIBs. QIBs include financial institutions, mutual funds and banks among others. Next term is preferential issue. Preferential issue means an issue of specified securities by a listed issuer to any select person or group of persons on a private placement basis and does not include an offer of specified securities made through a public issue, right issue, bonus issue or employee stock option scheme. Then, employee stock purchase scheme or qualified institutions placement or an issue of set equity shares or depository receipts issued in a country outside India or foreign securities. The issuer is required to comply with various provisions defined by SEBI, which inter alia include pricing, disclosures in the notice, lock-in, in addition to the requirements specified in the Companies Act. Then we can move through rights and bonus issues. Securities are issued to existing shareholders of the company as on a specific cut-off date, enabling them to buy more securities at a specific price in the case of rights, or without any consideration in the case of bonus. Both rights and bonus shares are offered in a particular ratio to the number of securities held by investors as on the record date. It is also important to understand that rights are like options and investors may or may not choose to exercise their rights, that is, apply for additional shares offered to them. On the other hand, in case of bonus, additional shares are conferred to the existing shareholders without any consideration by capitalization of reserves in the balance sheet of the company. The next term is onshore and offshore offerings. While raising capital, issuers can either issue the securities in the domestic market and raise capital or approach investors outside the country. If capital is raised from the domestic market, it is called onshore offering, and if capital is raised from the investors outside the country, it is termed as offshore offering. The next term is offer for sale or OFS. An offer for sale is a form of share sale where the shares offered in an IPO or FPO are not fresh shares issued by the company, but an offer by existing shareholders to sell shares that have already been allotted to them. An OFS does not result in increase in the share capital of the company since there is no fresh issuance of shares. The proceeds from the offer go to the offerers, who may be promoters or other large investors. The disinvestment program of the Government of India, where the government offers shares held by it in public sector undertakings or PSUs, is an example of OFS. It may be stated that OFS is a secondary market transaction done through the primary market route. Then secondary market, we can move through secondary market. The secondary market is where securities once issued are bought and sold between investors. The instruments traded in the secondary markets include securities issued in the primary market as well as those that were not issued in the primary market, such as privately placed debt or equity securities and derivatives of primary securities created and traded by financial intermediaries. The transactions in the secondary market do not result in additional capital to the issuer as funds are only exchanged between investors. The role of secondary market is to support the capital raising function of the primary market by providing liquidity, price identification, information signaling, and acting as a barometer of economic activity. The first term is liquidity. Secondary markets provide liquidity and marketability to the existing securities. If an investor wants to sell off equity shares or debentures purchased earlier, it can be done in the secondary market. Alternately, if new investors want to buy equity shares or debentures that have been previously issued, sellers can be found in the secondary market. Investors can exit or enter any listed security by transacting in the secondary market. The next role is price discovery. The secondary markets enable price discovery of traded securities. Each buy or sell transaction reflects in the individual assessment of investors about the fundamental worth of the security. The collective opinions of various investors are reflected in the real-time trading information provided by the exchange. The continuous flows of price data allow investors to identify the market price of equity shares. If an issuing company is performing well or has good future prospects, many investors may try to buy its shares. As demand rises, the market price of the share will tend to go up. The rising price is a signal of expected good performance in the future. If an issuing company is performing poorly or is likely to face some operating distress in the future, there are likely to be more sellers than buyers of its shares. This will push down the market price. The market price change continuously and they reflect market judgment about the securities. The next role is information signaling. Market prices provide instant information about issuing companies to all market participants. This information signaling function of prices works like a continuous monitor of issuing companies and in turn forces issuers to improve profitability and performance. Efficient markets are those in the market in which market price of securities reflect all available information about the securities. A large number of players trying to buy and sell based on information about the listed securities tend to create a noisy and chaotic movement in the prices, but also efficiently incorporate all relevant information into the price. As a new information becomes available, prices change to reflect it, then indicating its economic activity. Secondary market trading data is used to generate benchmark indices that are widely tracked in the country. A market index is generated from the market price of a representative basket of equity shares. Movement in the index represents the overall market direction. The S&P, BSE, Sensex and the NSE Nifty 50 are the most popularly watched indices in India. A stock market index is viewed as a barometer of economic performance. A sustained rise in key market indices indicate healthy revenues, profitability, capital investment, and expansion in large listed companies, which in turn implies that the economy is growing strongly. A continuous decline or poor returns on indices is a signal of weakening economic activity. Then, market for corporate control. Stock markets function as a markets for efficient governance by facilitating changes in corporate control. If a management is inefficient, a company could end up performing below its potential. Market forces will push down share prices of underperforming companies, leading to their undervaluation. Such companies can become takeover targets. Potential acquirers could acquire a significant portion of the target firm's shares in the market, take over its board of directors and improve its market value by providing better governance. An actual takeover need not happen. Even the possibility of a takeover can be effective mechanism to ensure better governance. Then we can see the market structure and its participants. The first participant is stock exchange. The core component of any secondary market is the stock exchange. The stock exchange provides a platform for investors to buy and sell securities from each other in an organized and regulated manner. Stock exchange stipulates rules for members who are permitted to transact on the exchange and for listed companies whose securities are permitted to be traded. The three national level stock exchanges in India are Bombay Stock Exchange, that is BSE, the National Stock Exchange, that is NSE, and the Metropolitan Stock Exchange of India Limited, that is MSCI. The trading terminals of these exchanges are present across the country. Then another participant is the members. Investors can trade in the secondary markets only through the members of a stock exchange. The trading members of a stock exchange are also called the stock brokers and their agents called authorized persons. They bring the buyers and sellers to the stock exchange platform, thus enabling trading in securities. Members will be admitted to an exchange only if they fulfill minimum requirements for capital, qualification, net worth and other criteria for admission. Stock exchange members can be trading members or clearing members or play both roles. Stock exchanges monitor members for their positions, capital and their compliance. Members' obligations towards their clients or maybe investors are also clearly laid down. The next participant is investor. If investors buy and sell shares among themselves, such trades are called off-market and do not enjoy the benefits of regulatory and redressal provision of the law. In order to get a competitive price and a liquid market in which transactions can be completed efficiently, investors come to the stock exchange and through their brokers. Investors complete a KYC, that is know your customer, process with a registered broker member and receive a unique client code, that is UCC. Institutional investors are supported by a distinct distinct arm of the broker member since they transact in large volumes. Banks, insurance companies, mutual funds, foreign portfolio investors are all large investors who may have their own dealers interacting with the member brokers who put their transactions on the exchange. Brokers also support investors with the market information, updates, research reports, analytical tools, and other facilities that help in buying and selling securities. Then another participant is issuers. Issuers are companies and other entities that seek admission for their securities to be listed on the stock exchange. Equity shares, corporate bonds and debentures as well as securities issued by the government, that is government securities and treasury bills, are admitted trade on the stock exchanges. There are specific eligibility criteria to list securities on the stock market. This can be in terms of size, extent of public shareholding, credit rating, ownership pattern, etc. Issuers have to pay a listing fee and also comply with the requirement for disclosure of information that may have a bearing on the trading price of the listed securities. Then we can see the trading, clearing and settlement. Secondary market transactions have three distinct phases: trading, clearing and settlement. To trade in shares is to buy and sell them through the stock exchanges. Stock exchanges in India feature an electronic order matching system that facilitates efficient and speedy execution of trades. After the trade is executed, the buyer has a payment obligation and the seller has a delivery obligation. In order to facilitate efficient trading, the execution of trades and the settlement of obligation are separated in modern stock exchanges. Clearing is the process of identifying what is owed to the buyer and seller in a trading transaction, and settlement is the mechanism of settling the obligations of counterparties in a trade. All stock exchanges in India follow a common settlement system. Trades take place on a particular day, that may be T, and are settled after 2 business days after the trading day, that is T plus 2. Next terminology is clearing corporation. In the modern structure of secondary markets, clearing corporations, or also known as clearing houses, are set up as independent, fully owned subsidiaries of a stock exchanges. They function as counterparties for all trades executed on the exchange they are affiliated with. So all buyers pay funds to the clearing house or clearing corporation, and all sellers deliver securities to the clearing house or clearing corporation. Specialized intermediaries called clearing members complete these transactions. The clearing house or clearing corporation completes the other leg of the settlement by paying funds to sellers and delivering securities to buyers. Recently, Securities and Exchange Board of India introduced the framework for interoperability among clearing corporations that allows the market participants to consolidate their clearing and settlement functions at a single clearing corporation, irrespective of the stock exchange on which the trade is executed. This will help in the reduction of trading cost and better execution of trades. The interoperability framework is applicable to all the recognized clearing corporations, excluding those operating in the International Financial Services Center, and all the products available for trading on the stock exchanges except commodity derivatives shall avail the facility. Some of the clearing corporations are NSE Clearing Limited, Indian Clearing Corporation Limited, that is ICCL, and Metropolitan Clearing Corporation of India Limited, MCCIL. Then we can see the risk management. Stock exchanges have risk management systems to ensure against the event that members of the exchange may default on payment or delivery obligations. Strategies such as maintenance of adequate capital assets by members and regular imposition of margin payments on trades ensure that damages through defaults are minimized. Exchanges thus enable two distinct functions: high liquidity in execution of trades and guaranteed settlement of executed trades. Then depositories and depository participants, that is DPs. For a security to be eligible to trade in the secondary markets, it should be held in electronic or dematerialized form. Issuers get their securities admitted to the depositories where they are held as electronic entries against investor names without any paper certificate. National Securities Depository Limited (NSDL) and Central Depository Service of India Limited (CDSL) are the two depositories in India. Investors have to open demat accounts with the depository participants who are banks, brokers or other institutional providers of this service to be able to trade in the securities. Demat accounts are similar to bank accounts in securities since the entries are electronic. Transfer of securities from buyer to seller is easily completed by paper or electronic instruction to the DP. Settlement of securities transactions is done through the demat account held with the DP, who in turn notifies the depositories of the change in ownership of the securities. Payments are made and received through specifically identified clearing banks. The next and final participant is custodians. Custodians are institutional intermediaries who are authorized to hold funds and securities on behalf of large institutional investors such as banks, insurance companies, mutual funds and foreign portfolio investors, FPIs. They settle the secondary market trades for institutional investors. Several custodians are also clearing members and clearing banks of the exchange and manage both funds and securities settlement. The regulator, secondary markets regulated under the provisions of the Securities Contract Regulation Act 1956 and Securities Contract Regulation Rules 1957. SEBI is authorized by law to implement the provisions of this act and its rules. It has empowered stock exchanges to administer portions of the regulation pertaining to trading, membership and listing. All the intermediaries in the secondary markets are subject to regulatory overview of SEBI and are required to register and comply with the rules as may be stipulated. Then institutional participants, we can see the institutional participants. An investor is the backbone of the securities market in any economy as the one leading surplus resources to companies for their productive activities. Investors in securities market can be broadly classified into retail investors and institutional investors. Institutional investors comprise domestic financial institutions, banks, insurance companies, mutual funds and foreign portfolio investors. Some of them are identified here in brief. The first is FPI or foreign portfolio investors. FPI is an entity established or incorporated outside India that proposes to make investment in India. These international investors must register with the regulator SEBI to participate in the Indian securities market. Then P-note participants. The participatory note or P-notes are instruments issued by SEBI registered foreign portfolio investors to overseas investors who wish to invest in the stock markets without registering themselves with the market regulator SEBI. P-notes provide access of Indian securities to these investors. Then mutual funds. A mutual fund is a professionally managed collective investment scheme that pools money from many investors to purchase securities on their behalf. Mutual fund companies invest the pooled money in stocks, bonds and other securities depending upon the investment objective of the scheme, which is stated upfront. A fund manager with the help of a research team takes all the major decisions in terms of the companies to invest in the percentage of each stock in the portfolio, when to exit and so on. Each investor owns units which represent a portion of the holding of the fund. Diversification of investment is an important aspect of mutual funds investing. It helps in reducing the risk in investment for the investor. As a result, the investor is less likely to lose money on all the investment at the same time. Then insurance companies. Their core business is to insure assets. Depending on the type of assets that are insured, there are various insurance companies like life insurance and general insurance, etc. These companies have huge corpus and they are one of the most important investors in Indian economy by investing in equity investments, government securities and other bonds. Like mutual funds, each insurance company also has designated people who are responsible for investment decisions. Then we can see the pension fund as a participant. A fund established to facilitate and organize to the investment of the retirement funds contributed by the employees and the employers, or even only the employees in some cases. The pension fund is a common asset pool meant to generate stable growth over the long term and provides a retirement income for the employees. Pension funds are commonly run by a financial intermediary for the company and its employees, although some larger corporations operate their pension funds in-house. Pension funds control relatively large amount of capital and represent the largest institutional investors. Then we can see the venture capital funds. A venture capital fund refers to a pooled investment vehicle like a mutual fund, but with mandate to invest money in enterprises that are in the early stages of development, but with the potential of long-term growth. The longer gestation period and higher risk of failure make it difficult for such companies to access conventional sources of finance, such as banks and the capital markets. Venture capitalists bring managerial and technical expertise as well as along with the capital to their investee companies. Then PE firms or private equity firms. PE or private equity is a term used to define funding available to companies in the early stages of growth, expansion or buyouts. Investee companies may be privately held or publicly traded on companies. The term private equity includes venture capital firms. The money in the fund is contributed by investors called limited partners and invested and managed by the general partners. Some of the private equity funds are specialized funds with competence in a particular industry, stage of the company or targeted deals such as funding buyouts. Then hedge funds. A hedge fund is an investment vehicle that pools capital from a number of investors and invests that across the assets, across the products and across the geographies. These fund managers generally have very wide mandate to generate return on the invested capital. They hunt for opportunities to make money for their investors wherever possible. In that sense, actually, term hedge fund is misnomer as these funds may not necessarily be hedged. Alternative investment funds. Generally, investments in stocks, bonds, fixed deposits or real estate are considered as traditional investments. Anything alternate to this traditional form of investments is categorized as alternative investment. Even within investments in stocks, if the investments are in the stocks of small and medium scale enterprises, that is SMEs, it gets categorized as alternative investments in many jurisdictions. For instance, the SME exchange is called alternative investment market in United Kingdom. Then we can see the retail participants. Retail investors include individual investors who buy and sell securities for their personal account and not for another company or organization. HNIs or high net worth individuals and UHNIs, ultra high net worth individuals, are individual investors who invest large sums of money in the market. Reserve Bank of India has also granted general permission to non-resident Indians, NRIs. Then person of Indian origin, that is PIOs, and qualified foreign investors, QFIs, for undertaking direct investment in Indian companies under the automatic route. Then we can see the main security market products. There are many financial instruments issued in the market, each with a distinct risk and return characteristics, and that defines its suitability for an investor. The first product is equity shares. These are issued by companies. The main investors are institutional and individual, that is retail and HNIs. Their mode of operations or medium is direct issuance by companies and stock exchange. The regulator is SEBI, regulators under the Companies Act. Equity shares represent the form of a fractional ownership in a business venture. Equity shareholders collectively own the company. They bear the risk and enjoy the rewards of ownership. Then the next product is debenture or bond or notes. These are issued by companies and government and special purpose vehicles or SPVs. The main investors are institutional and individual. Their mode of or medium is direct issuance by issuers and stock exchange. The regulator is RBI, SEBI, RBI or maybe SEBI. Regulators under the Companies Act. Then the debentures and bonds and notes are instruments for raising long-term debt. The debentures are either unsecured or secured, backed by collateral support in nature. There are variety of debentures bonds such as fully convertible, non-convertible and partly convertible debentures. Then warrants and convertible warrants. The next product is warrants and convertible warrants. They are issued by companies. Investors are institutional and individual. Their medium is direct issuance by companies and stock exchange. The regulator is SEBI. Warrants are options that entitle an investor to buy equity shares of the issuer company after a specified time period at a given price. Only few companies in Indian securities market have issued warrants till now. Then we can see the indices. A market index tracks the market movement by using the price of a small number of shares chosen as a representative sample. Most leading indices are weighted by market capitalization to take into account the fact that more the number of shares issued, greater the number of portfolios in which they may be held. Stocks included in an index are also quite liquid, make it possible for investors to replicate the index at a low cost. Narrow indices are usually made up of the most actively traded equity shares in that exchange. Other indices to track sectors or market cap categories are also in use. The most widely tracked indices in India are the NSE's Nifty 50, S&P BSE Sensex and MSCI's SX40. The S&P Sensex has been computed as the market cap weighted index of 30 chosen stocks on the BSE. The SX40 is composed of 40 most representative stocks listed on Metropolitan Stock Exchange of India Limited. And the Nifty 50 is composed of 50 most representative stocks listed on the NSE. The shares included in these indices are chosen on the basis of factors such as liquidity, availability of floating stock, and size of market capitalization. Then we can see the mutual fund units. They are issued by mutual funds. The investors are institutional and individual. Their medium is direct issuance by mutual funds and stock exchange. The regulators are SEBI or RBI. Mutual funds are investment vehicles that pool together the money contributed by investors, which the fund invests in a portfolio of securities that reflect the common investment objectives of the investors. Each investor's share is represented by the units issued by the fund. Then ETFs or exchange traded funds. They are issued by mutual funds. Their investors are institutional and individual. Then the medium is direct issuance by mutual funds and stock exchange. The regulator is SEBI or RBI. ETF is an investment vehicle that invests funds pooled by investors to track an index, a commodity or a basket of assets. It is similar to an index fund in the sense that its portfolio reflects the index it tracks. But unlike an index fund, the units of ETFs are listed and traded in demat form on a stock exchange, and their price changes continuously to reflect changes in the index or commodity prices. ETFs provide the diversification benefits of an index funds as well as the facility to sell or buy at real-time prices. Even one unit of the fund. Since an ETF is a passively managed portfolio, its expense ratios are typically lower than that of a mutual fund scheme. Then we can conclude this module. In this module, we are covered mainly meaning of security markets, primary and secondary markets, primary market terminologies, role of secondary market structure and its participants, and security market products. Thank you.